Welcome back. You are watching the Women's Edition or Women's Wednesday edition on Buy Now, Sell Now. And in this latest edition of Women's Wednesday, we understand the importance of liquidity in ETFs and how crucial is the liquidity factor for your portfolio. To get more perspective on all this and more, my colleague Kavita is here in conversation with Mirae Asset's Pavitra Parekh. Listen in to this interesting conversation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this very special segment called Women's Wednesday. I'm Kavita Thapliyal and today we'll be focusing on ETFs once again, but then we'll be talking about liquidity in ETFs. And to elaborate more on this, I have with me Pavitra Parekh, investor engagement from Mirae Asset Mutual Fund. Hi and welcome to this very special edition on ETFs yet again. But we'll be talking about liquidity and other aspects of investing in ETFs. But then before that, let's talk about how important is the liquidity factor in any kind of asset class or investor instrument that you choose.
All right. Thanks a lot for having me on again, Kavita, first of all. And liquidity, I think, is an extremely important factor for any investor when they're getting in.
Sure.
Essentially, it's how quickly your investment can be turned back into cash, right?
Yeah.
If I'm getting in and I want to liquidate my investments at any point, I should be able to do that without any concern on, whether there's a seller for it, whether there's a buyer for it or not.
Yeah.
So I think for any investor, it's very important. In that respect, of course, the larger names we all know are very liquid. They are all, well traded in the market.
Yeah.
And there are a lot of things that AMCs also do just in terms of the indexes that they create. They have a certain eligibility criteria for stocks to even enter that index.
Okay.
And they try to make sure that, these are all very liquid investments. So, for example, for the more nuanced ones where, you can have smaller names entering, ETFs will sometimes, or AMCs will sometimes have an eligibility criteria where they will say that, only if a stock trades in the F&O segment, then we will include it. This is just to kind of safeguard the investor's interest and say that we want a very, very liquid portfolio. If you want to sell, you will be able to sell.
But how liquid a portfolio should actually be? I mean, what percentage of your portfolio should actually be liquid, or all investments you need to have it liquid?
I mean, it depends. Of course, in terms of mutual funds, there is liquidity in two respects. One is how liquid are the units that you have bought.
Sure.
And the second is how liquid are the underlying securities that you're buying as well, right? I mean, of course, if you're getting into, say, a fixed deposit or an ELSS, of course, by nature, those are not liquid investments. And you are getting in fully aware of that. So that is fine. But if I'm getting into a standard, equity index fund, ETF, even an actively managed fund, I as an investor expect that tomorrow, if I want to sell this, I will not have any trouble doing it. In that respect, I would like all of my investments to be very liquid.
All right. So how does this liquidity in ETFs actually work? If you can just elaborate on that in detail.
Yeah.
So they obviously mirror an index, and there are securities included in it. So how does it work?
So like I mentioned, it has to be in two respects. One is how liquid are the units. So what is the kind of trading volume of the units? And second is the underlying securities. So the underlying securities are the stocks that the index is basically investing into. Very, very important in an ETF, because if they are not liquid, if they are not buying and selling at the correct, actual price of the ETF, the cost can just go completely absurd. Then it means that the investor will be paying at a, very abnormal price for it. It doesn't happen because, there is a full mechanism in place to make sure that that doesn't happen. But that is how important it is for an ETF to be trading at fair value. You need that liquidity to be there in the system.
All right. Any timing related discipline that an investor needs when they want to liquidate their ETF investment? Is there a pattern, or it is just need based, or depending on the investor and their requirement?
No, so this is entirely dependent on the investor. ETFs are actually very, very easy to liquidate because they're trading on the exchange. They trade, as easily as a stock. So today, if I open my demat and I say, okay, I want to get rid of, say, 500 units of a certain ETF, I can do that on the spot.
Okay.
For a mutual fund, which is not traded on the exchange, I would at least, have to wait till the end of the day, and then it will take that those 2 days to give me back my money. But for an ETF, you can do it on the spot. So in that sense, ETFs are actually more liquid than funds which don't trade on the exchange.
But that alone cannot be a factor why you should be investing in ETF. I mean, that's a very big plus, no doubt about it. But then what about considering that the only factor?
No, absolutely not. It's not the only factor at all. And but it's something that's, it's a matter of convenience.
It's a matter of convenience.
Yeah, it's not at all the only factor, but it's just something that differentiates also an ETF from an actively managed product or from an index fund that doesn't trade. Another thing I'll just mention with ETFs is that, who buys and sells ETFs? Either it's an existing investor or it's a new investor or it's something called a market maker. Now, what a market maker is going to do in the market is that it will provide you both the bid price and the ask price. So essentially the buying and selling price. And these should ideally be very close to each other. There can be a few basis points of a difference, but they should trade very close to each other, and that value will be close to the fair value of the ETF. The fair value of the ETF is just all of the underlying securities. If you take that and you take for 1 unit of that ETF, market makers ensure that that ETF trades very close to its fair value, and then the investor gets essentially what he is buying in the market.
What about the tax implications involved here?
Tax implications are pretty much the same as they would be in any active equity product. So there isn't a change over there in terms of whether it's a short-term capital gains or a long-term. So there's no change there. But when we're talking about liquidity and ETFs, another thing I want to mention, because I think a lot of people don't realize this when they buy into ETFs, is that you need to be going on, say, the AMC's website and checking something called the indicative net asset value. This will show up to you as the INAV. And so check that price and then go on your DMAT and check the price that you're actually getting the ETF for. These should be very close to each other. A few basis points is fine. It's just the transaction cost that's involved. But essentially, if they're not trading close to each other, if I see the INAV at a particular value and what it's trading at a much higher value, that means I'm having to pay a premium for it. That's what's happening to some of the international ETFs right now. So that is something that investors need to be aware of and take into account. This also shows you liquidity. A very large difference means that it's not a very liquid product.
Exactly. So there are also certain red flags that one should be considering. Also, it depends on the market situation that particular day, right?
Yeah, it depends on the market situation. So what I mentioned to you of trading at a premium, you're never going to see it with a very standard ETF or an ETF based on Indian securities as well, because the underlying stocks are very liquid, at least the ones that the ETFs are based on. Where you are seeing it is the international products, ones. That's because of a certain SEBI regulation which has come in. Apart from that, there's really no need to worry as far as the liquidity in these goes, because AMCs go out of their way in their part as well to make sure that all of the underlying securities are liquid, and tomorrow, should you want to liquidate, the market maker can also absorb a large chunk of what you want to sell.
Across market caps, talking about Indian equities, even small cap and mid caps will have enough liquidity if one wants to liquidate?
Yeah, I mean, like I told you, there is an eligibility criteria in these. So you're anyway creating a filter to say that these are the kind of stocks I want included in my portfolio and these are not. And then I mentioned that there is a market maker. So that market maker's entire job is to buy and sell in large chunks, right? So if you have a certain amount of ETFs and you want to sell, the market maker has the capability to just absorb whatever quantity you want to sell. That is why it becomes so important. And also, I mean, they're going to do it at a fair price. They're going to do it at the correct, traded price, because you shouldn't have to sell it at a discount either. So all of these factors are in play to ensure that there is liquidity in any of these investments.
So it is as easy as investing in ETF, right?
Yeah.
I mean, you just have to go on the AMC website and get the thing done. There is no other complication. If one is doing on their own, like a direct investment, so there are no other complications involved. It can be any financial platform that you are trying to do it, or through an AMC website. It's that easy. Because we're talking about women investors, and I mean, they need a step-by-step run-through maybe. So just log on to the website and just go on the particular ETF that you've bought and check the liquidity.
Check the INAV. So you will get, it's the indicative net asset value again. Just check that price, check what it's quoting on, whatever platform you're using to transact. And ideally, in most cases, it will be very, very close. And that's how you get to know that you're paying a very fair price. And this is, a liquid investment that you are paying a fair price for. You're not having to pay a premium. When you sell, you're not having to do it at a discount either. These are just kind of health checks that you do for any ETFs. Because there are so many trading out there in the market, you just want to make sure. And I mean, this is something that we all learn a little bit later on about. But it's a very simple process. The other thing is that, because these are traded on the exchange, the price is constantly changing, right?
Exactly.
So on the AMC's website also, you'll see every 15 seconds that price changes a bit based on, the underlying securities. So it trades exactly like a stock, you'll get very used to it. But just as it keeps changing, you can see what it's quoting on the exchanges.
All right, I think liquidity in ETF simplified by Pavitra. Thank you so much for being on the
Thank
show
you.
today. And that'll be all. It's a wrap. Thank you so much for watching.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.